Good afternoon, subscribers. Let me now please talk to you about section 5.3, financial regulation, the importance of the regulation of financial markets. And of course, within this particular bullet point, you are asked to evaluate. So let's think about this, and let's think what we could put in terms of the regulation, but also then what we could discuss in terms of evaluative points. So this is by no means a finite list, but hopefully this is something to get you started. So when my students and I looked at this today, we were thinking, okay, we're thinking about the role of the Financial Policy Committee, and of course, the FPC. Remember, ladies and gentlemen, today we've just had the inflation number, 2.3%, and I hear that our Prime Minister, Mr. Sunak, has just put out a briefing for a press conference at 5 p.m. Predictions are, ladies and gentlemen, the election is going to be called. You heard it here first. Okay, let's get back to the evaluation. FPC. So what things have been implemented since the financial crisis in order to regulate the banks more tightly? Number one, counter-cyclical capital buffers. Counter-cyclical capital buffers. What a great phrase to include in your exam. Remember, they were introduced after the financial crash. What does that actually mean, counter-cyclical capital buffer? It means that the banks are required to hold more cash in reserve or more liquid assets in reserve should they come under strain, as of course was the case during the financial crash when the banks went bust essentially, except for the actions of the government to introduce the sovereign guarantee. And so the counter-cyclical capital buffer promotes confidence in depositors because they believe, okay, even if there is a run on the bank will have enough money there to pay out whatever monies I have deposited with the bank. So that's number one. Let's not forget that deregulation can be traced all the way back to the 1980s. So the supply side policies of Prime Minister Margaret Thatcher in the 1980s, and many people would often say that the 2007-2008 financial crash does emanate from and did begin with the deregulation in the 1980s. Don't forget about the banks then being required post-financial crash to raise their cash deposit ratio. Again, just promoting confidence and ensuring the banks have more deposits. Should there be a run, then they'll be able to pay out depositors' cash should they require it. Don't forget about home buyers. So in the run-up to the financial crash, I remember buying a house myself back in the early noughties, and the bank was offering me 120% mortgage, so I could borrow the price of the house plus 20% extra for fixtures and fittings. Great it was back in the day. But of course, that meant that monthly payments on mortgages were enormous. Nowadays, there's a much stricter regulation in place, an affordability test, which means that banks are no longer able to do this, although we will say a little bit more about that in a moment. Don't forget about the Financial Services Compensation Scheme, whereby if you've got £85,000 lodged in a particular bank and the bank does go bust, then the government will guarantee that essentially. Remember, if you want to start a new bank, the Bank of Dave, you might have seen it on Netflix, Dave's been trying to set up a new bank for 20 years. So the Monzos of this world, the Starling banks of this world, very, very difficult, and rightly so, to be able to set up your own bank. And one final thing, I suppose, would be with regard to subprime lending and the systemic risk that's associated with that. The financial crash emanated in the US through subprime loans, which then spread across the Atlantic due to systemic risk and the way in which the financial markets are all woven together. And so even though the shock, the asymmetric shock started in the US, we then suffered as a consequence. So those would be some things to sort of discuss in terms of the regulation aspect. Well, what about then your evaluative points? What can we say in terms of, have these things really been implemented strictly? Have they been loosened more recently? Or have they not been introduced at all? So let's talk about bankers' bonuses. There was a whole clamour post-financial crash, it only happened because bankers were chasing big bonuses, and really they were when you're gambling other people's money, that's an easy thing to do, isn't it? So you can take big risks, and if you don't bear the burden of that risk, then you're more likely to take the risk. And that is a behavioural economics aspect, isn't it? The moral hazard aspect, because of course, if the government just says, right, well, these bankers, they wreak havoc, they earn substantial bonuses, but we then will introduce a sovereign guarantee to guarantee your deposits, the bankers then have no incentive to change their behaviour. That's moral hazard, as you know. Contrast that with Italy. Iceland. In Iceland, the Icelandic bank went bust. The government pursued the bankers and even jailed them, some of them. Now that did happen to a limited extent in the UK. There were trials and so on about manipulation of the LIBOR, the London Interbank Offer Rate. However, it was very limited. They are also now in danger of reverting back to their former practices. So the cash deposit ratios post-financial crash were raised. Now the cash deposit ratios have been reduced, or there are calls to reduce the cash deposit ratios. And of course, that's you think to yourself, have these bankers, have they not learned from the past? We raised the cash deposit ratio in order to protect the banking system. Now we are lowering it. Surely that is foolish. The whole idea of 100% mortgages, again, these are starting to reappear on the markets. Well, they're much more risky. It's much more likely that you might end up in negative equity. So again, have we really learned our lessons from the past? I leave that with you, ladies and gentlemen. Au revoir.